Okay, I think we are live here with episode 2 of the Anderson Report. I am Tim, the Source Anderson. Uh, I want to really thank everyone for joining us. And we're going to get right into it here. We're going to take a look at today's market action, today's economic data, and talk about the market averages a little bit and why they diverge so much. So, basically what we had today was a market that gave up some of the gains from earlier in the week. We've had two pretty good up days and two pretty good down days for the Dow and the S&P, and of course the Nasdaq is just really trading in a mind of its own with an additional gain and a new all-time high today. So the Dow lost about 1.4%. The S&P lost a little over 0.5%. The Nasdaq gained a little over 0.5%. Volumes were moderate. Breadth was clearly negative, with advancers trailing decliners by 3-1. Three stocks declining for every one that advanced. On the Nasdaq, that breadth was a little bit better, with decliners really only leading advancers by about 2-1. Now, quite a bit. The day really started with headlines out of China that they have done a pretty good job of talking their market higher. The Shanghai Composite, which is their benchmark index, has gained 17% in 8 days. There was clearly messaging from the head of the Chinese government a week ago, and continued throughout into this week, encouraging people to buy into the Chinese market. It's had such an effect that today they were even trying to tap down enthusiasm a little bit. They've gained 17% in 8 days. I think that's a little bothersome to people who have followed moves in the Chinese market before. We did get the employment, the weekly claims number at 8:30 this morning. That showed some improvement from last week and some improvement from all the numbers that we've seen over the last couple of months. But really, the numbers still need to get a lot lower for a very healthy economy and to represent the gains that the stock market has had, anticipating the economy really kicking back into gear. Weekly jobless claims came in at 1.3 million. That was better than consensus at a little bit less than 1.4 million. Continuing claims dropped to 18 million. Consensus was for that to drop to about 19 million. Really, that number needs to get below 15 million, even pushing at 12 million, hopefully by the end of the month, if not within by the middle of August. So that number was some improvement. It's improved every week, but frankly, I think that improvement needs to be much more than what we've seen the last couple of weeks. Again, it's probably hampered a little bit by some states pausing their economic reopening plans, and by restaurants still at maybe a 25 to 50% capacity restriction, and in some areas still restricting indoor dining. When we got the June employment numbers at the end of last week, There were very, very large gains in travel, leisure, and entertainment. Over 2 million jobs added in those areas. We're going to need to see uh, restaurants and hotels make significant improvement in their capacity by later in the month for to see significant improvement like that in the July employment numbers that will come out on the first Friday of August. Okay, so the market was down fractionally. The Dow was down about 100 points into about an hour into trading, and then we got Supreme Court decisions on a number of things, including uh, somewhat of a split decision on Trump's financial records and tax records. A, whether or not they could be accessed by congressional Democrats, and B, whether or not uh, prosecutors in New York State and or New York City could access those records. It was a big win for the Trump administration on the congressional side, but it was a mild loss for them against the prosecutors in New York City and New York State accessing those records. Although I think it's very clear that the need to know requirement that they would have to produce to get a subpoena signed off by a court in New York City or New York State would not be able to be executed before the election, and any requirement that they would get access to those records would not come until well after the election. Now, that notwithstanding, the market had quite a move to the downside immediately upon that news hitting the tape. But what, uh, um, and I think that there was probably a knee jerk reaction by some headline reading algorithms, and maybe by some buy orders that were in the market that said, wait, let's cancel these orders for a little bit until we can figure out exactly what's going on here. The market did recover in the next couple of hours following that. The NASDAQ recouped its losses and got back to even. The S&P recouped what were more than 1% losses. The Dow struggled to recover its losses and finished the day down almost 1.5%, a much larger decline than the S&P 500, and clearly diverging from what the Nasdaq um, showed with gains of about 0.5% at the end of the day. Now, there was a couple of reasons for this, and we're going to get into that. There was also some very confused reporting by some financial news services at the end of the day. There were headlines after 4 o'clock. Dow decline led by Walgreens Boots Alliance down 8%, Raytheon down 5%. The reason that these headlines really don't make any sense is because the Dow, unlike the Nasdaq and the S&P 500, the Dow is an arithmetic index, where the S&P is a capitalization weighted index. And what I mean by that is, in the S&P, the stocks that have the highest market cap have the highest impact on what the index does. So if the story was the S&P decline led by large percentage decline in stock A, large percentage decline in stock B, that would make total sense. But to say that the Dow decline was led by a 9% decline in Walgreens Boots Alliance, which had a terrible earnings report, and the Walgreens is a Dow member. I believe it replaced GE about 2.5 years ago. And Raytheon down 5%. That doesn't really make any sense because Walgreen Boots Alliance was only down $3.40. And because the Dow is an arithmetic index, a $3.40 decline in Walgreen Boots Alliance, which is about a $40 stock, would have the same effect on the Dow as a $3.40 decline in Boeing, which is almost a $200 stock. So really, the decline in the Dow declined over 360 points, was led by Boeing down $7, Goldman Sachs down $5, and United Healthcare down $7. So the combination of those three stocks contributed to a little over a third of the decline in the Dow, because a $1 decline in any stock in the Dow, whether it's a $40 stock or a $300 stock, and Apple is over a $300 stock, has the same effect on the Dow. There is something called the divisor, which has really become a multiplier, that a $1 stock, a $1 gain or decline in any stock in the Dow is equivalent to a $6.85 move in the Dow Jones Industrial Average. So for Boeing to decline $7, Goldman Sachs to decline $5, and United Healthcare to decline $7, that adds up to about a $135 decline for the total Dow, where really Walgreen Boots Alliance declining $3.40, even though it was down 9%, is only a $25 decline. Raytheon declining 2.8%, even though it's down 5%, is only a $20 decline. So I, of course, won't mention the financial news website that led that story, with the Dow declining, being led by a 9% decline in Walgreens and a 5% decline in Raytheon. But I just wanted to give people some feel for what really drives the Dow and why it's a little bit different than what drives the S&P 500. It also has some impact on the fact that the Dow is a narrower, very blue chip index, that companies have to have a long-term track record over many years to get included into the index. There's 30 stocks in the index, where there's 500 in the S&P 500, and I'm not sure exactly how many, a few hundred in the NASDAQ composite. So those stocks are where Apple was added a few years ago. A number of years before that, Microsoft and Intel were the first over-the-counter names to be added to the Dow Jones Industrial Average, well over probably 10 or 15 years ago. But the really, really, really high-flying stocks, a lot of which have been driving the NASDAQ to new highs, just don't have the long-term track record yet to be added in to the Dow. And it's also very, very unlikely that the Dow Jones would add a stock like Amazon that trades above $3,000 a share into the Dow Jones Industrial Average. Remember, Apple used to trade over $1,000, $700 or $800 a share. It split 7-for-1 before it was added into the Dow. Now, if Amazon was added into the Dow, a $3,000 stock, and it went down 4% or 120 points on a certain day, that would equivalent that would be the equivalent of close to 1,000 point drop in the Dow Jones Industrial Average, and they don't want to add that volatility to an average that's trading at just below 26,000 with today's close. Already a lot of price volatility in the Dow. They're not going to add another a stock that trades $1,000 or higher. Frankly, I think they would probably like to see Boeing, which was a $350 stock a couple years ago and is now, I think they'd like to see Apple maybe even split again, to take some of the price volatility day to day out of the Dow. All right, enough on that. Um, the other things that went on today really were a very bad earnings report from Walgreen Boots Alliance. We mentioned that, and also Bed Bath and Beyond um, announced that they're closing 20 stores. Clearly, the retail space is a very, very challenging space for a lot of companies in the coronavirus environment. Retail is a brutal business, just for starters. I'm sure that Bed Bath and Beyond has a lot of competition from many other retailers, including online retailers, including the likes of Walmart and Target. And I think that they have had a lot of challenges even before uh, the coronavirus has wreaked all havoc on destination shopping retail establishments. So we had a very choppy, uneven market today. The Dow was down 1.4%, down 360 points. The S&P down a little over 0.5%. The Nasdaq up a little over 0.5%. The Russell 2000 also beat up quite a bit, down 2%, to close right at 1400. I've talked quite a bit about the Russell having this very large price gap on the way down in early March between 1350 and 1450. It had worked very hard to close that gap. It's still in that range, closed right at 1400, right in the middle of it. Um, a lot of technical resistance for the Russell between here and 1400, 1450, still down over probably 12% year to date. Oil had a rough day, uh, down over 3%, still at $39.50. A lot better than where it was a month ago, but a number of headlines at the end of the day that this was the first close for crude oil below the $40 level in since July 1st, which was a week ago Wednesday. So just over a week. Uh, Oil had uh, gotten through that. I think that $40 level is a little bit of a threshold for oil. The energy sector was the largest declining sector of the S&P complex, down 5%. And although that's a larger decline than what we saw for the price of oil, down a little over 3%, I think the fear among energy investors might be that, all right, we got above 40, almost to 41, couldn't hold that level, closed at around $39.50. If we go back and test maybe the $38 level, that's going to cause another wave of selling in the energy sector, especially if the economic recovery is going to be a little bit more uneven than what we had thought we were looking at maybe a month ago. And um, oil companies will be a lot more challenged with oil in the high 30s than they would be if it had worked its way into the 41, $42 level and could hold that range all the way through the summer. So we've got to watch energy very closely uh, the rest of uh, the month of July to see if it can hold a lot of the gains that it's made over the last 2 months, maybe get back above that $40 level, maybe try to work a base above the $40 level and move higher. Although I think that energy investors are not totally convinced of that right now. The other main weakness in the market today was financials. The yield on the 10-year bond went down from 0.65% to 0.6%. I think, again, if the economic recovery is going to be halted a little bit by a large increase in coronavirus outbreaks, um, that we have seen over the last couple of weeks in some large population areas, the financials are um, not going to, certainly going to continue to struggle throughout the third quarter. It's been years since the financials have been a leadership sector for the market. Uh, they've shown some pretty positive signs of life over the last 3 weeks, but they were down 2% today. We have to watch that sector going over the next couple of weeks. Industrials down 2% also. Again, um, if people are worried about the strength of the economic recovery, industrials are going to struggle a little bit. Now, some signs of life still in consumer discretionary, up a little bit less than 1%. That's a very positive sign. That shows that um, investors feel that consumers are going to be flush enough and have enough pent up spending interest that they're still going to be able to buy things that they went without through the depths of the market sell off following the coronavirus outbreak. Consumer discretionary spending would be a key sector of the S&P to show some life, some signs of life, uh, if the economic recovery were to, get through these stops and starts that we've had with the outbreak of virus cases and pick steam back up maybe toward the end of the month. Also, information technology up 0.4%. That's obviously big tech, internet support stocks, and consumer services pretty much unchanged. Again, both info tech and consumer services, uh, big players in the internet traffic trade momentum that has fueled the NASDAQ rally over the last few weeks, really since the recovery off the March lows. Um, at some point in time, if we were to sell off more, uh, that you'd probably have a little bit of hiccup in the rally in NASDAQ. But I just think that big Dow investors aren't going to give up on this internet traffic trade unless they feel that things are have changed significantly on a fundamental perspective from all these companies that have had so much benefit from the exponential increase in internet traffic from both streaming and online shopping and people working at home. Even if the NASDAQ were to pull back 3 to 5%, and maybe it's 5% above the 10,000 level, which we were concerned about maybe being a sell signal 2 weeks ago. Uh, but now we're over 5% above it. So even if we came back to test the 10,000 level, the NASDAQ would still be in a very strong, very powerful uptrend. So that's pretty much what we had today. I think tomorrow, of course, the last day of the week, the market averages still have, of course, the NASDAQ still has very strong gains, up over 4% for the month of July. We're only 6 trading days into it. S&P still up about 1.5% for the month of July. Dow down fractionally for the month of July. Nasdaq or Russell 2000 down about 2.5%. We don't have a lot of economic data tomorrow, but next week will be the full force kickoff of second quarter earnings season. Now, this earnings season, more than any other, a very much backward looking number. Everybody knows that the second quarter was very bad for the economy. Corporate earnings are going to be just horrific. It's going to kick off with the big banks on Monday. A lot of companies have dropped their full 2020 year guidance, which I think is probably the prudent thing to do since there's so much uncertainty on where the economy's going for here and what the pace of the recovery is going to be throughout the third quarter and into the fourth quarter, that it really doesn't make a lot of sense for companies to have guidance for even the third quarter and the fourth quarter when there are so many variables casting so much uncertainty on the strength of the economy. Why have a guidance number out there that you're most likely to miss anyways? But that notwithstanding, it will be very interesting to hear what the banks have to say about what they're looking at going forward into the third quarter and into the end of the year. It will be interesting to see what their comments are about the PPP program and how they feel that worked for them. Now, I think that the PPP program was a lot more tailored for smaller local banks and community banks. They're just set up a lot more to be a lot more in tune with that size of company that was designed to get those funds to help, restaurants, restaurant chains, hardware stores, local businesses in towns and cities. Those are the companies where your community bank and your local bank is going to be a lot more comfortable with what those companies are than your big banks, Chase Bank, Bank America, Wells Fargo, et cetera, et cetera, et cetera. And of course, when the PPP program was first rolled out, a lot of headlines and a lot of chatter about the struggles and complaints, really a lot more aimed at the big banks than the smaller local and community banks. But it will still be interesting to see what the banks have to say early next week. Couple comments in the system. When does a lucrative employment? And I think you're talking about the extra $600, people making more money on the side than they would be if they went back to work. Currently, that is only scheduled to be in effect through the end of July. So after the end of July, people that are filing for unemployment will just get what their state mandates as their unemployment compensation. They will not get the additional $600 federal kicker per week on top of that. That may be a boost for employment in August, but clearly there will have to be jobs available for those people that are still out of work. And they're talking about some incentives in a next potential stimulus plan that will not include a federal kicker on top of the weekly unemployment, but maybe some incentives for business, maybe some incentives for people that are going back to work. A lot of that's still very speculative right now. I don't know that the details for that are going to be ironed out for at least a couple of weeks, but I'm sure they will be defined before Congress goes on their much ballyhooed summer recess. Another comment here about the best way to play gold, precious metals. Gold traded at the highest level yesterday than it did since 2011. It got up to about $18.30. I believe it traded as high as $19.50, 1950, 1960. I think that in 2011, gold did not quite get to 2000, but it's a little bit above 1800. I get the impression it's got a shot to go through 2000 this time. And silver closed above 19 yesterday. I think it may have also closed above 19 today. It was off a little bit. Silver got as high as between $35 and $40 in 2011, although that was very short lived. And very shortly after that, it traded down to the low 30s. But remember, the catalyst for that big move at that point in time was the big problem that started in Southern Europe with Greece potentially needing a bailout from the EU. And then I believe when there was a major budget impasse in the fall of 2011, and we had a potential debt payment issue looming. I think believe the U.S. government debt was downgraded from AAA to AA by a couple of credit agencies. And that's what really sparked gold to threaten the 2000 level and got silver up into the mid to high 30s. There are also some other structural things with gold. I'm going to do a little bit of a longer thing on gold. I want to get up to speed on exactly what's going on with it. I'll talk about it a little bit more in depth next week. Does one rationalize the Tesla stock? It makes no sense to me. Just let me make one comment, a little bit of a housekeeping note. I currently work for a broker dealer in New York. I am registered by FINRA. I am not a stock market, a registered analyst. It's very dicey for me to comment on individual stocks because nothing that I say can be interpreted as investment advice or anything even near a buy or sell recommendation. And I can comment on stock sectors. I can comment on the overall market. I've really kind of tailored this as an analysis recap type show. I know that everybody would love to have opinions on Tesla. Clearly, in people that are buying Tesla here are playing long ball, feeling that this is a long term story, that they're in for 5 to 10 years, that they have, uh, and the investors that are sticking with the stock, even adding to positions here, feel that they have technology that is uh, unmatched by any other company out there. And they're doing a little bit of a faith walk with uh, Elon Musk, who is clearly a revolutionary guy. And they are not buying it for its current valuation or even its valuation next year. I'm not going to disagree with you that it makes no sense, but I can't get into a deep conversation about it because I can't have it viewed as potentially being a recommendation on what to do with the stock. I would just say that some investors that are sticking with Tesla here are viewing it the way they viewed Amazon 6 to 8 years ago when it was still unprofitable, but making massive investments in their infrastructure of their business for the future. That paid off for Amazon. Whether or not that pays off for Tesla is just way beyond my realm. The one thing that I would say is I think that their business model will be a little bit more challenged with uh, gasoline in the below $2.50 if oil were to sell off and not get back up to where gasoline gets back up toward the $3.5 range. That being said, I think there are always people that will like the Tesla product and pay a premium for it. But whether or not the stock is is overvalued here, I think is really a function of what your time horizon is. Um, so the other thing that's really pretty much all I have tonight. I think that today's a Friday, the first full week of the month, the first full week of the third quarter. I think it could be an important day for markets to uh, stabilize after the up, down action we've had over the last 4 days. But really, although the Dow was down 360 points, down 1.4%, the S&P was up 0.5%. Then the S&P was down 0.5%. The Nasdaq was up 0.5%. The overall market was uh, certainly acted better uh, than the Dow, skewed to the downside by very by selling in the industrials, the cyclicals, and even the energy sector with Exxon and Chevron both down over 4%. Those weren't big declines for the Dow, but emblematic of the fact that cyclicals and industrials struggled today. The one thing that I would also watch closely is the what we call the internals of the market, or the breadth, meaning really the advanced decline. I mentioned it very early in the broadcast that the earlier in the week when the market had some very strong gains, the advanced declines were only up maybe 2 to 1. They should have, and that was maybe a little bit of a warning sign. It was a little bit of a warning sign that the Russell was underperforming, which is consistent with the breadth of the market not being as strong as the averages. The Russell was down 2% today. I would watch that closely tomorrow and into next week. Certainly, if it were to continue to sell off and trade below the 1350 level, I'd be a little worried about it. And I'm going to watch the advanced decline numbers closely um, tomorrow and as we get into next week. So that's pretty much all I have today. I want to thank everyone for joining us. Uh, there may or may not be a show tomorrow. We'll send out an alert through Twitter to update everyone. If you haven't subscribed, I'd appreciate it. We got a lot of new subscribers just in the last 24 hours. That's great. And everyone have a very safe evening, a great weekend, and we will talk to you again soon.